Welcome to the Crypto 101 Show, the best place to learn, understand, and grow with your cryptocurrency education for all ages, starting with the basics to help you get a solid foundation with all things crypto. What are the fundamentals of cryptocurrency? I need to start off by saying this is not financial advice, so if you are looking for that, this show isn't for you. The content of this podcast episode is for informational purposes only. The opinions expressed here are not meant to be taken as financial investment or any other advice. I really wanted to touch base on this topic. This is probably a little advanced for basics, but I felt it was helpful to understand this part when digging further into cryptocurrency markets and how all of this starts to work. So far in the episodes of the Crypto 101 show, you've learned what cryptocurrency is, including key terms and basics, why cryptocurrency was created, including a brief history of it, how cryptocurrency is worth anything, including its store of value, and if they are safe, and defining the difference of being safe to purchase versus safe as an investment. So I think it's good to start talking a little about the fundamentals of cryptocurrency. The term fundamentals literally means a foundation, a basis from which you use to understand something. Investors use what is called foundation analysis, which is how they establish the intrinsic value or objective calculation of an asset or business. They can look at a number of internal and external factors, and the main goal is to determine whether that said asset or business is overvalued or undervalued. They can then leverage the information to strategically enter or exit positions of the asset. This should not be confused with technical analysis, which is financial analysis that uses patterns in market data to identify trends and make predictions. Being able to separate the market price from the true value of a network is an excellent skill to have when trading. The problem is cryptocurrency networks can't really be assessed through the same lens as traditional fundamental analysis. The fundamental beliefs of currencies are typically units of measurement, stores of value, and mediums of exchange. I want to clarify here, there is different outcomes for what you choose to do with cryptocurrency. Do you choose to hold or hodl your cryptocurrencies, or do you choose to trade it with riding the peaks and valleys? These fundamentals can be different depending on your outcome. Also, each coin is different from the next. Crypto fundamental analysis involves taking a deep dive into the available information about a financial asset. For instance, you might look at its use cases, the amount of people using it, or the team behind the project. Your goal is to reach a conclusion on whether the asset is overvalued or undervalued. The concept of fundamental analysis is simple. If you see a coin with a value that isn't proportional to its price, it may be worth looking into. The challenge with fundamental analysis is identifying projects with high potential and to accurately determine their future value. You'll need to do a lot of research, so let's break down the 5 basic fundamentals you should at least look at. There's the tech behind it, the progress of the crypto, the team behind the coin, the competition of the coin, and the main big one, as much as I hate saying it, is the speculation of the coin. The tech. What does it offer that is significantly better than traditional technologies? How do decentralization and distribution make it better? The progress. What are the ongoing developments? Git pushes, which Git is software for tracking changes in any set of files, usually used for coordinating work among programmers collaboratively developing source code during software development. And are the team meeting their deadlines? The people. Who is in the team? Who are the strategic partners in the community? And how widely adopted is the cryptocurrency they have created? The competition. What other cryptocurrencies tackle the same problem or same space, and how does one fare better than the other? And the last one is speculation. This means when you see Elon Musk or any major investor or celebrity tweeting about a specific crypto coin going to the moon, or that they are going all in on a cryptocurrency, this can drive up or down the price in a quick moment depending on what is being said. This adds tremendously to the volatility of cryptocurrency, and speculation is extremely difficult to account for with it. With knowing these fundamentals, I want to clarify a few things beginners need to know. These 5 mistakes should be avoided as a beginner when understanding these fundamentals. This is just my advice, as others may not agree with me. First, don't do this if you are trying to get rich quickly. Second, never try to time the markets. They are volatile and you will lose the majority of the time. Third, never invest based on emotions. Fourth, never try to day trade cryptocurrencies. And lastly, avoid coins that are called shitcoins. Shitcoins are cryptocurrency coins with little to no value or digital currency that has no immediate discernible purpose. Shitcoins diminish in value the same way a new stock issuance may reduce or dilute the value of a share of stock. Let's take these a bit further. Getting rich quickly sounds lovely, but can get you into a lot of trouble. It's one of the reasons the 1929 stock market crash happened, as many small-time investors had FOMO, or fear of missing out, and jumped in only to lose most of their investments. Timing the markets is something only few people are able to do. There's so many indicators and understanding you need to have, and crypto is so volatile that it's nearly impossible, which is why most investors hold or hodl their positions for years. Emotions can get the best of us. The highs are high and the lows are low. Don't get emotionally attached to the coins you are investing in. And try your best to avoid speculation from celebrities or major investors. The last thing I will say to this is only start with a little at a time, and only with funds that you could stand to lose if something went badly wrong. My only personal preference I will say to this is I view it as a speculation on something that could one day increase radically in value. I'd rather have a share of potential gains than be 10 or 20 years in the future regretting my inaction, whether that hesitance had been born out of cynicism, excessive caution, or ignorance. There's no one-size-fits-all fundamental analysis playbook. Let's sum this up for this episode. You now have an understanding of what the fundamentals of cryptocurrency are. There's the tech behind it, the progress of the crypto, the team behind the coin, the competition of the coin, and the speculation of the coin. You also now know everything you do with crypto, you are doing at your own risk. You are solely responsible for any trades, investments, gains, or losses you receive. This was extremely simplified for a beginner, and I recommend still doing your own research. I want to be extremely upfront that I try my best to leave all of my opinions out of this, and I understand this episode I had to issue my own personal warnings to any beginners with trading, purchasing, or holding crypto. I want you to gain your own understanding and beliefs and not be persuaded by me. I hope this helped you gain a better grasp of it. On that note, please remember to share, follow, and subscribe for future episodes so you can gain more with your crypto knowledge. Thanks for listening and see you next time. Thanks for listening to this episode of the Crypto 101 Show. If you'd like to join our email list, email us at thecrypto101show@gmail.com. For more helpful tips, subscribe in your favorite podcast app so that you don't miss our next episode.